Alright, welcome to another episode of Blockrevision. Today, as always, presenting you the most important news that may impact prices, may impact valuations of stocks, equities, indexes, cryptos, and so on and so forth, as we are making a breakthrough to many of investment assets. That's why I think that our series is one of the most highly expected to bring you a great outlook for data and what's going on around in a macro picture. So today with only audio, without video, as I'm broadcasting for you live from my personal studio of my room. That's why this episode and Monday's one will be in that manner. So we are jumping straight forward to supply issues that gives Fed sleepless nights. So recently, many of the banks has predicted that this time Fed may increase Fed interest rates by even 100 points, but it's kind of unlikely as to not spook the market. Right now the market may be discounting that scenario, but me and for instance major banks as JP Morgan says that right now those distortions reflected by a very high inflation may be going away within next months, but for now rising interest rates by that high is really outstanding. So the Fed possibly won't overreact and maybe has already made it in August, but in July, but there are no really clues for making it by 100. That's why the market is possibly estimating this hawkish view of Fed. So, but does it really? That's a good time to take a risk stance. That's a little bit too early. We would rather watch of what Fed has to tell us, and regarding this, we will make our outlook for next weeks and months. So that will be very important event next week. So subscribe to our channel in order to be updated. It's all right. So right now we do expect the 75 basis points increase, where every misstep and every single too big hike will make in this environment problems to be amplified exponentially, I would say, even. So they would rather be keeping the line with this path that have previously indicated by many of speeches, and right now we do expect rather to behave by Fed the behavior to be firm but not scaring and daring the broader outlook. Recently we've told about local commodity supply problems that may be kind of increasing due to this US railroads being frozen, literally, by transports being stopped. Right now we can find that US railroads and unions reached a tentative deal, so we can find that among them were around 100,000 workers that reached an agreement. So this agreement gives union members an immediate 14% rise, among which it also includes raises totaling 24% during the 5-year life of the contract. So it looks like that maybe an avert a labor disruption that risked recently adding supply chain strains to the world's largest economy, and that's something that may be bearish for commodities in order to have these suppressions to be eased eventually. But for customers, for the US habitants, that's definitely one that was highly expected. We know the rises doesn't come from anywhere, so that may also have its reverberations on the level of inflation, but that's the I would rather fiscal measure that shouldn't really make those troubles much more complicated. So we'll possibly see defreezing infrastructure that transports about 40% of all long-haul cargo in the US. So eventually we are hopefully will stave off the one problem that brought a wave of logistic chaos. In fourth quarter, we'll see cracks everywhere. That's what Mr. Stanlich, billionaire, said. So he expects many of the crashes among the market. The continuation of rate hikes may have its much bigger perturbances going ahead in the future. So that's something that we do really need to ponder when those billionaires are speaking in that kind of a fearful manner. That's something that brings and turning on a little bit like a yellow, or even in some terms a red light for investors and companies that thinking of flourishing during next quarter. So consumer confidence here points being terrible, as well as CEO confidence is miserable. That's what makes his stance that serious. But there is some of the very renowned personalities that are buying the blood. So Mrs. Wood recently acts as though she bought a premium on Audible and listened to every single Warren Buffett's book biography. She's getting ready for deflation right now. But whether it comes or not, she is buying equities right away. So that's also the point of view that recently Elon Musk made, that we do expect those deflationary issues to turn up, and Mrs. Wood right now is walking the walk and is sticking to her strategy to doubling down on losers and offloading winners. So that might be good, but it's still too early to say whether we might be heading to deflation. For now, this demand may be stopping, but doesn't mean that customers' confidence may improve. It's very difficult for now, as we do not see any of those behaviors yet. So it's kind of a gambling, kind of a uncertain move, but it may pay off for her if she bets right. So it may take even years for having those valuations that Mrs. Wood has bought right now somewhere back to where it were in 2021, and even with this one in consideration, it doesn't guarantee that all of that startups will eventually survive. So those penny stocks may be waiting for another boost of easy money that will be highly unachievable in today's reality, I would rather say. But can 70s be a performance indicator? Right now we are heading relentlessly into those 70s years where we had two big drawdowns in valuations and also in consumer prices, where we were finding that we are almost over. We had another devastating spike that has risen up to 14%. So the similarities for the first half of 70s are significant right now. The war that happened back then, and also the commodity valuations in the years 70 to 74, it was around 180%, as I remember correctly, as measured by GSCI price index. Right now it's around 200%, or maybe a bit more less. So that's why we are finding some of the similarities, and that's why we may find that during that time that happened back then, we may observe the bear market that usually most often bring in over around 37.5% of a drawdown, but by now it's around 16%. That's why we may halve from here if that scenario may repeat itself. So there are some of the projections, as I would say, cannot be treated as a kind of a repetitive model, where the reality rather rhymes than repeat, but definitely it's something that may make the nights sleepless for investors. Job market doesn't reflect problems, but that's what recently been founded by me. United States average weekly hours. So with previous phenomenon, that's quiet quitters that turning up on U.S. job market, we can find that many of workers confessing that they are not really psychologically detached from the are not 100% psychologically attached to their work due to psychological or personal issues that may be a reverberations of those COVID problems, isolation, or something like healthy issues. So productivity is dropping, and it should reflect average weekly hours gauges. When productivity drops, literally the CEOs are rising average weekly hours in order to keep up with productivity, effectivity of the business. That's why we may have seen a spike, and that's something that may where some many of analysts where we have those projections, these spikes are very often goes on par with kind of a economic problems. So on market outlook, let's have a look at something, the event that recently had taken place, triple witching event, where we had many of options being expired, and very often those options being expired in tandem, as it was right here, where expired options on the amount of over 3 trillion bucks. It usually the chance for the market, the chance for investors to swap their positions, to rethink their attitude, their approach, and right over to make another point and bet in the possible reverse tendency. That's why we may see a major move right after possibly this Fed have its speech. So the next week might be quite volatile. So the market is expecting the Fed interest rate decision right over. We would find there will be much of a more chaotic price action. Investment grade spread right now shows that risk of defaults among market breadth is low, relatively low. So the analysts from Goldman Sachs don't find this environment has been very risky, but in the reverse, FMS investors are panically scared. So right now, what we can find that these are literally the street. The street is betting for the apocalyptic epic bearishness. So whenever it happens like that, this is something that we supposed to be really big into. Whenever it happens, and whenever this that kind of bearishness happens, that's normally a bullish sign. This dealer survey, and also something that's been recently reflected in American Association of Individual Investors surveys, shows that we are really tend to be, as a smart investors, contrarian bullish on the market, even if that many bad news are just rolling over, as we are revolving around the possibility of much more headwinds. I do find that's more like a bullish one than bearish to be among those circumstances. Regarding the positioning, the merely positioning, that's the one of the most important psychologically proved investors rating that shows what the future price action may look. On the other hand, however, I need to really bring more I would say reflection of what's going on with earnings per share. Right now we are still on this very dangerous territory where in any time soon we're supposed to see a revert to the average trend. Will it happen this year? Maybe not, maybe next year, but it's supposed to happen any time soon. In terms of crypto outlook, we are just heading into the most hotly debated issue from a crypto market. So after this Ethereum merge, many of the debates about centralization happen. But with this one, I would like to at first point that Ethereum needs, in order to gain an interest from investors, to get another very strong narration. So merge already happened, yeah. Many of users are really joyful of that, but in order to push the price forward, we need another catalyst. So this Ethereum merge has been debated even in 2020 that will happen. That's why the price of recent hasn't reacted that strongly. So the price of Ethereum has been pushed on that news, and when it eventually hit, we've seen a sell on the news phenomenon that was kind of a predictable to occur. So after successful merge, market is looking for another valuation accelerator. Another step for Ethereum is the phase called the surge implementation of sharding scaling solution, which will lower the costs of bundle transaction of Ethereum. That's very important in order to having Ethereum to chase Visa, because that's one of the problems that recently been also kind of an obstacle for development, where this Ethereum usability been discussed. That always the talk that always reverberates is that Ethereum is too slow to keep up with Visa terms. So in terms of bandwidth and transaction speed, there's sharding about to get delivered around 2025. If the new bull market gets sparked around 2024, according to structural nature of halving cycles of Bitcoin, that may be the narrative of the next cycle. But sorry, that's a parrot. That's the parrot in my room, somewhere in the flat. So if that will happen, we may see another cycle of interest, another bullish cycle of interest in Ethereum investments. So for now, that might be a narrative that we may keep up. So 2023 might be relatively calm. 2024 is supposed to be the one that will have that another major interest. That we may see another major interest in Ethereum. But what about centralization? That's the problem that may face the users may face in order to defend their point of view in keeping their investment outright. So in blockchain we have a blockchain trilemma. The trilemma means that in order to verify the high possibility of security, speed, and also what was the last one? Security, speed, and the last one I just remind in a second. We need to have at least two of them in order to having the token to perform in a right manner. So this time, when the centralization may get suffering due to this many of units, many of entities being in a possess of Ethereum tokens being staked, we may find that exchanges that has been depicted right here maybe in a mainly under government control, and such exchanges as Coinbase or FTX may even run in transaction censorship. So there will be monitor trading, and also due to this many possibly market manipulations. That's why we need to right now focus on that eventually Ethereum will prove its usability, and this resilience from US government and those companies that may have tendency to steer the path of Ethereum development. Otherwise, Bitcoin will have been on the forefront of an innovation and of a revolution on and on. So I would like to sketch in here with a comment regarding Bitcoin. Maybe it seems a boring, slowly developed chain, and there are some accusations that it would be more valuable if Bitcoiners prioritized intellect over dogma and open to the crypto world and take the best of alts. But this boredom and opposing changes attitude might be a guarantee of a network security. So ponder this one. So that's the few cents of me. Old people yell at Bitcoin. So recently Mr. Taleb has called Bitcoin a tumor. I would say, yeah, the Bitcoin might be a child of this low rate policy, but it doesn't mean that it's really useless. It's kind of a freeing us up from this banks no alternatives hinge, and I would say that that's definitely much more important to have alternatives rather than one of the dominant power that steers and steers how the humanity behaviors. So the central banks supposed to have an alternative in terms of crypto. That's why in order to not have been kind of a totally dependent from one entity, we need crypto as well. In terms of market movers, let's have a look quickly at this one. So just literally initial jobless claims, yeah, has dropped. That I mentioned on Thursday we had industrial production from China. It kept up with better gauges, so it means that's one of the consoling one regarding recent headwinds that China also had. Today we have had retail sales from Great Britain, and that one is more pessimistic than it's supposed to be, and we are awaiting Michigan consumer sentiment that is yet to be released. In terms of another topic, that is trade idea, let's have a look quickly at this one. So for today, I have just the outlook on DXY. The DXY is this index of a dollar. Right now we are approaching a very important level and just breaking out of this 110th level. That's why I do expect there will be another surge in DXY. If you have a chance to bet for DXY, I would make it right now, or if you don't, there is right now very strong tendency on USD that it may get lower with this one. And this one point recently been achieved and been highly rejected. We do rather expect that USD should have another move downward. So I do expect that USD will spike before it slides. So kind of a arbitrary level I do expect is this level of 1.009, and with this one I do find another chance. If you haven't kept that move, I find another chance to bet against Euro USD. So this risk reward ratio is even up to 5.6, so it's very decent, and it's the one of the position that you're supposed to keep even for 2 months as regarding recent price action and the volatility been performed. So that's it in today's episode. Thank you very much for watching, and if you have any questions, just put it in the comment section below the video. So see you on Monday, 8:45 9 a.m. East time.